Hello traders, and thank you for joining us on this trader tip today. Today is going to be the third part of our chart type series. The chart types which we'll be discussing today are going to be ones that don't focus on the time. So no matter what you set your time frame to, these charts will always look the same. This is an obscure concept to a lot of traders since they're more so focused on every period this happens, and they're looking for these trends based off of periods. But there are a lot of traders out there who do enjoy the concept of non-time based charts because they show you strictly trend and it doesn't matter really what the time happens. All that matters is when the price moves in what direction. So let's go ahead and take a look at these charts. The first type of chart we'll talk about that does not concern time is called a point and figure or point and figure chart. Point and figure charts are composed of two different columns. You have columns of X's and columns of O's. To add the different columns, what we need to look at is what we set our settings to within Alveo. So here you can see the chart price dial screen, which will happen on Alveo anytime you select any of these non-time concerning charts. In this case, we selected point and figure. So what it'll ask us is box size and reversal size. And so what we'll put in here is we'll put in the box size, which is how many pips we want it to move in any direction to go ahead and place a new box, which is either one of these X's or one of these O's. The next thing we'll see on this menu is reversal size. The reversal size is how many pips in the opposite direction does the price need to go before it starts a new column. So in this case, they're both set to 1. So if it moves 1 pip up, it adds an X. If it moves 1 pip down, it then switches over to a new column and adds an O. And so typically that reversal size is going to be a little higher. You'll usually see that set to 4. And so what that means is every time we move 1 pip up, we'll add one of these X's until we reach the top of the column. Then once we go, the market goes against us for 4 pips, then we'll start that new column and add an O. And then after that, every pip down it moves, since we're now on a new box size, every pip down it moves, we'll add a new O. Then once again, once we get that 4 pip reversal, we'll go ahead, add an X, and for every pip up it moves, we'll have an X on that new column. The thing with point and figure charts is you can never have an X and an O in the same column. So depending on that reversal size will depend on how tall those columns can get. The larger the reversal size, typically the larger it will need to be to go ahead and start a new column. So if we go ahead and look at this chunk right here, for example, we have 4 X's, and so it moved up 4 pips, and then we have 1 O, and then we have 4 more X's. So we went up 4 pips, down 1, up 4 more, based off of the settings which we see right here on box size and reversal size. If we had that reversal size set to 2 though, this O never would have appeared and these X's would have moved over to this column right here, and we wouldn't have seen it until this column right here where there's a reversal. These point and figure charts can present a lot of trends in them. The most common is these pennant-like trends right here, where traders will trade breakouts off of these pennants. There are other types of trades which you can do off of these point and figure diagrams. But what we're mainly focused on today is just what the charts present. And so point and figure, each X or O is going to present a movement in the bullish or bearish direction of our box size. And we'll start that new column with the new letter once we have a reversal in the amount of pips as the reversal size. And so as you can see, it doesn't matter how long it takes. If we're in a consolidation and we just keep moving up and down, let's say 2 pips at a time, but our reversal size is 3, we're not really going to see a shift in those columns that could last for days or hours or however long this consolidation lasts. That new column will only form once price moves a certain amount. And so this is the first of those non-price type charts which we'll be focusing on. Once again, these are just trends that we're really primarily looking at. The next type of chart is the Renko chart. Out of all of the non-time looking charts, the Renko is probably the most common. Once again, they're another Japanese-based charts, and they're somewhat similar to the point and figure charts. The point and figure chart, however, in the Renko vary from the fact that the Renko chart and the point and figure chart, the box size is going to be the same as the reversal size for the Renkos. And so here we can see it only asks us for the box size because the reversal will be that same box. And so if we look at this point and figure and this Renko, they'd be very similar. We'd have that same, we'd just have this many, they're called bricks on the Renko chart, and then we'll have this many bricks down, and we don't concern ourselves with the reversal pattern. So here we went up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 pips up, 1 pip down, 4 pips up, 1 pip down, 1 pip up, 1 pip down, etc. And so once again, we're not concerning ourselves with time. All we want to know is how much has the market moved in a certain direction. If it's moved 5 pips and our box size is 1, we'll see 5 of these bricks side by side. If we set our box size to 3 and we move 5 pips bullish and then 3 pips bearish, we'll only see 1 brick in that bullish direction, and then we'll have 1 brick in the bearish direction, just like we see here. So depending on the strength of the reversals that you want to identify, that will also present itself in the strength of the continuations, which makes Renko a really good trend indicator here, and we can pretty easily see when reversals start just based off of this trend right here. And so that's the primary purpose of the Renkos compared to the point and figures. The third chart type which we'll discuss is the Kagi charts. Kagi charts is another Japanese chart which does not follow any time amount or anything like that. What we really look for with the Kagi charts is a reversal size. And so each of these lines will be a continuation of however many pips. And then once we reverse a certain amount, either a percent or number of pips, then we'll go ahead and shift direction. With Kagis, since the point and figure is primarily used for a reversal of a certain amount of pips, Kagis you'll usually see set to a certain percentage. And that percentage is most commonly done at 4%, which you can see I've selected here on the settings. Type we could also change to the price movement or how many pips it moves. And in that case, reversal size, we would just put in whatever number for pips. But we could get the same information based off of a point and figure chart. And so Kagis, you'll traditionally use percent change. Another thing you'll notice with the Kagi charts is that there's different thicknesses to the lines. And so one of the things is if we dip below the lowest low, we'll have a thin blue line. And once we go above that highest or the previous high, not necessarily the highest high or lowest low, but once we go above the previous high, we'll go ahead and make that thick green line until we dip below that lowest or the most recent low, in which case we'll transition to that thinner line. Looking at the thickness of the line is traditionally where you'll see traders enter the trade. They're not so concerned with this right here movement. They're more so concerned with this movement where we dip below the low. And so once we've exceeded that certain percentage in the opposite direction based off of the recent trend, and we see that line shift right there, is when we'll go ahead and enter. So if we see the blue line shift from thick to thin, traditionally we'll go ahead and sell. And if we see that green line shift from thin to thick, traditionally you'll see a buy happen. Until we get this sort of plateau effect, this peak or trough, which is where we reach that 4% reversal. And that's where you'll see traders exiting the trades most of the time with Kagi charts. The next type of non-time concerning chart which we'll look at is the 3-line break chart. How the 3-line break differs from other non-time concerning charts, however, is it uses a time concerning chart for its data. And so what that means and how that works is each of these bars is considered a line. From there, once you open up the 3-line break chart, you'll get this menu right here where you'll need to select the line break. In this case, it's 1. Usually you'll see it a little higher. 3 is the standard, which is why it's a 3-line break, but you can change that to any other number. You can change it to 7 and call it a 7-line break chart, or whatever you'd like, but it's called a 3-line break chart. Traditionally, it's 3 lines or 3 candles. And after that, you can go ahead and change those values to whatever you'd like though. For the 3-line break chart though, what it'll look at is it'll look at the time-based chart, and if we don't have a close that is broken the high or low, depending on the direction of the previous 3 candles, then it won't go ahead and draw a new candle. We'll only get a new one of these lines once we've broken the previous high or low of the previous 3 candles on a time concerning chart. If we don't break the 3 previous candles, high or low, we'll just keep going ahead and continuing on in that bullish direction as we get new higher highs until we go ahead and we break the 3 highs. And so each one of these candles, in this case it's 1, we can see each candle had broken the high or the low of the previous candle and started forming. And then we can see where that one closed, where it opened, and then at what price it broke the next or the previous 3 highs right there. So the 3-line break is the most time concerning chart for non-time concerning charts, which sounds a little confusing. And the 3-line break is not a exceptionally commonly used chart type either, just because of some of the confusion that it does instill in people. For those that use it though, and for those who are interested in using it, it does have its applications. Once you go ahead and break support or resistance from the previous 3 candles, or however many candles you select, that's when you get a new one of these lines. So they are very useful in support and resistance break charts, as long as that support or resistance is going completely horizontal and you don't have a sloping channel on your chart. So that's it for our chart types. We've discussed all of the different chart types which you'll find in Alveo. We've looked at our more basic ones, which are our highs, lows, opens, closes, our bar charts, our candle charts, line charts, and those types of charts. We've looked at volume charts, which are similar to those candle charts. However, they take into account how much volume a trade is pushing through, and we'll see the width variation of those candles depending on that. And we've discussed our time charts, or our non-time concerning charts. These charts are primarily used for trends, looking at support, resistance breaks, or just general strength of trends overall and strength of reversals. So thank you all for watching. Hopefully this has helped you with some chart types, and maybe you'll experiment with a few of them and find out that you like some more than others. So thank you all for watching, and happy trading.
To change the chart types on Alveo, right-click on the chart and scroll down to the price style. From there you can choose the chart type of your preference. Like and subscribe to our channel to be updated on future videos.